Welcome to the Apartment Investor Pro podcast, where we talk about how to be a more successful multifamily investor with a focus on using technology to boost your business. And now your host, Todd Heitner.
Welcome to the Apartment Investor Pro podcast. Today our topic is all about creating successful multifamily partnerships. In line with the proverb, if you want to go fast, go alone. If you want to go far, go together. We're digging into how to build your team so you can build your dream. Today I have with me Kelley, founder of REI Mom. Anna is a seasoned real estate investor who's done everything from renovations, rentals, commercial, small multifamily, large apartment complexes, you name it. Her portfolio includes over $160 million across several states. And she's here today to share her experience and guidance with you. She talks about why investors are more comfortable when more people are involved in a deal, when to grow your business with the same partners versus doing your deals with a variety of different partners, how to identify why you personally need to find your best partners, and who should consider continuing alone, and more. So let's get to it. Hey, thanks so much for coming on today, Anna. I appreciate that. How are you today?
I'm great. How about you, Todd?
Yeah, really good. Yeah, I appreciate you coming on today. And we're going to be talking today about partnerships. That's an important part of multifamily investing. So whether a person's maybe currently working a job and trying to get into this, or maybe they're already kind of getting established, a partnership is something a lot of people think about. So could you tell us a little bit about like what exactly is a partnership in the context of multifamily syndication? Why is that important to think about?
Sure. So with apartments, especially if you're moving into the syndication world, typically it's very difficult to take down a large apartment building completely by yourself. So if you're starting out and you're buying your first, multi-unit, like a 4-unit, 10-unit, something like that, sometimes you can do that on your own because you've got your own, the time, the skills, and the money availability to do that. But once you want to start really growing that portfolio, people usually run out of either time, they're spread too thin, or their skill set, may be really conducive to one area of the life cycle of apartment investing, and they need someone to come in and help, or they run out of capital. And so, you look at joint ventures and you look to find partners that can maybe take down, a building with just a couple of you. And then as you want to grow and build into, grow into bigger apartment buildings, you obviously need a number of partners. And so it's rare to see someone take down a large apartment building completely by themselves. And so it's a business model really conducive to partnerships.
Okay. I would think too, if a really big deal too, people might be more comfortable dealing with, like investors might be more comfortable if there's multiple people involved too, right?
Definitely. You don't want the only person running the show. Something happens to them, God forbid, they pass away, they're incapacitated. You need, a breadth of people who can step in and still make sure that the business plan is executed. Yeah.
Okay. Great. And so obviously there's some important benefits of having partners. What about I assume then that we need to be careful though who we choose as a partner. So can you give us some things to think about when that, as far as like making that choice about who to partner with?
Sure. I look at investing with partners really kind of like dating and marriage. You're not going to jump right into a marriage with somebody without having had dated and try to get to know each other. And so, it's really important before you decide, hey, I want to bring in partners, that you think about, what do I need in a partner? You don't want someone exactly like yourself, because then you're going to have redundancies. You really need someone that has a complementary skill set, complementary passions, because, maybe you're both really good at different things, but you're not that passionate about what you're good at. And so you need to make sure that your passions, your skill set, and also your financial goals and your time priorities are well aligned. Because a lot of times, someone might be really risk averse and they just want some, nice, stable, long-term buy and hold assets. And other people are willing to take a little more risk for a big chunk of payout at the end. And so if your risk tolerance and your financial goals are not well aligned, that could be a problem. If your skills are not aligned, as we mentioned, and also your time availability and what you're willing to sacrifice in terms of your time in order to make a deal or a company grow. So you've got to think about things like, how much time are you willing to put into this venture? Do we make a better, short-term partner and let's pick a deal, do the deal together? Or are we both committed to the long-term growth and want to build a company and, willing to sacrifice, 40 or 50 hours a week outside of what else we're doing to grow that company. So those are the primary considerations. And then within that, there's obviously a lot of questions you need to ask to kind of dig deeper.
Yeah. Okay. So you need to not be exactly alike, but at the same time be compatible. So like where you can
Right.
together. Yeah. I think that I know that's the case in marriage. Sometimes those differences can create conflict at times, but at the same time, if you learn how to work with those strengths, it can build a better business too.
For sure. And I think that's where, you've got to really kind of get to know your communication style, your conflict handling style, and your personality. If one person's a complete pushover and the other one's very domineering, you might have some hard feelings. If you're both very dominant, you're prideful, you like your way or the highway, there's going to be conflict. If you're both completely melancholy and phlegmatic, you're not going to move your business forward. So you've got to kind of be able to figure those things out. And while sometimes it's hard to really know how someone's going to handle adversity or difficult situations till you get there, I think it's important to ask the kind of questions like, how do you handle conflict? Or do you like to communicate clearly and concisely? Do we have to touch base every day or just when there's big issues? Who wants to control what decisions? How collaborative do we need to be? So all those things are really important. And unfortunately, people jump into apartment syndication bed together often just because, hey, I like this person or I met him at a meetup group without really taking time to think about, is this a good partnership?
Yeah, that makes sense. And I'm just curious, do you ever have, or would you recommend people do a personality test, for example, just to kind of see what some of those different strengths and weaknesses are?
Yes. And I know several people who do ask their partners, potential partners, to do a personality test. Sometimes they're really good, and there's certain ones that really help you to kind of, open your eyes about different things that could cause conflict. Other people really don't like them because they feel like it doesn't, there's no one test that really well represents, who somebody is. But if all partners agree to do it, it could be a really eye-opening tool and a useful tool to say, hey, where might there be some issues where we'll conflict?
Yeah. Yeah, I could see how that could be the case. We've done that even like with our team and our business. We kind of do that to see kind of what, sometimes it's the best way to communicate with somebody. You learn, okay, this is how they like to be communicated with. And so here's the best way to communicate with them, or here's their strengths or their weaknesses. And you can kind of work with those better if you're aware of them. So
for sure.
yeah.
And even if you don't do a personality test, I like to go through questions that help me to figure out what somebody's personality is, and to go through, questions like that and ask them, do you tend to be more aggressive? Do you tend to be, more hold back? Do you like to fight it out when there's issues and get it all on the table? Or do you like to, sit back and think and put it in writing? So all those kind of questions you still need to ask and figure it out, even if you're not doing a formalized test.
Yeah. Okay. That makes sense. And so, with the partnerships, then we kind of talked about how like people are going to do different things. So how important do you think it is as the business owner to know everything in the business, know every aspect of the business?
Yeah, I think it depends kind of on your business model. So for example, if you really wanted to grow a company and your company is going to start doing, multiple deals together, and you're hiring staff within your company to do each role, that's different than I'm going to be a syndicator and I'm going to do deal by deal with different people who are also in the syndication space that each have a role that they like to play. So, there are some leaders who they'll find a deal, and what they're really good at is finding the deal, underwriting the deal. But then they want to hire an asset manager who's going to oversee the property management company and executing the business plan. And they're kind of like very high level, but don't get down into the weeds. There's other people that are really like, they want to run their company. They've got to know the role of every person. They've got to oversee all their employees. They've got to make sure they're accountable to certain KPIs. So, if you're in the syndication space and you're a sponsor, you've got to have a high level understanding and oversight of everything. And then depending on how big your team is and how big your business grows, you can start, delegating and allocating certain roles and responsibilities to executives at each area. And then you become more like a business leader without having to be as much into the weeds in the day-to-day.
Okay. So having an idea of the big picture, like the main things that need to get done, but maybe not necessarily every little detail that everybody's managing then.
Sure.
Yeah. Okay. Great. And so then what about the structure of the partnership? How can you tell us like how partnerships can be structured?
Sure. So again, it kind of depends on the size of the deal and how much work each person's willing to put in. So, there's joint venture partnerships where it might just be two or three people. And maybe one person is primarily the money partner and they bring, capital to the deal. But they really, want to be still fairly passive. To not be a syndication, they all need some form of an active role. But maybe it's I'm contributing capital. I want to be notified when there's big decisions. I want to see, quarterly P&L. And otherwise, I'm leaving the day-to-day to another partner or partners. And so, there are joint ventures that are worked out there that way. If there's only two partners or three partners, each of you is going to have to take on, a more substantial role because there's a lot to do, in the day-to-day. So oftentimes you see things broken up into kind of deal sourcing, the one that's really in contact with brokers and trying to find deals and pound the pavement. You've got someone that's usually a little more analytical that'll do the detailed underwriting and try to make sure that the numbers pan out. Somebody's got to take care of the banking relationship and making sure that you can get the loan, review all the legal contracts, et cetera. Then you move into property management, asset management, who's going to kind of oversee that day to day. And then, the financials, who's going to look at the financials and the budget and make sure you're sticking to what you're supposed to. So a lot of times you see a different person in different roles, depending on if they're more of a, outgoing, they want to be, always networking, bringing in investors, talking to brokers versus very detailed data analytical. And so typically, whether you're doing this in a joint venture or you're doing it in a syndication, you're going to have very clearly defined roles of partners. And so you need to make sure that when you talk to partners, you say, what are you really good at? Where's your experience? And what are you passionate about? Do you want to take on this role? And is this the right fit for you in this deal? Or is there something that you're better suited to? And so if you can identify the roles that need to be filled and then find the right partners that can fill those functions, with passion, competence, and experience, then that's really the best way to put together a partnership instead of saying, hey, I like you, you like me, let's figure out how to do it together when maybe it's really not a good fit for a particular deal.
Yeah, that makes sense. And you talked about how maybe a partner could be somebody that just provides money toward the deal. I can see how that could be beneficial too, because like in other like passive investors, if you're trying to get them involved, they're going to feel more comfortable if you as a company have money in the deal. And if you don't have that money personally, then it still gives you a way to have as a company have money in the game, in that
Sure,
deal.
sure. Yeah.
Okay, that's great. And so kind of on a related note, should you expect a partner to contribute financially to running the business?
I think, again, that really depends on whether you're doing this as a one-off deal, let's partner on this deal, or whether you're trying to grow a company. I mean, if you're trying to grow a company together, you're going to have a lot of expenses maybe before you ever get your first deal together as a company. So there's, a lot of expenses with travel and viewing deals and costs of hard money for deals that may fall through. And so you're going to have to be able to say, hey, partners each need to step up and take a financial risk as well as personal risk, in building this company. When it comes to doing a syndication, I've seen where certain partners don't have any personal skin in the game. Maybe they're at a place where their money is tapped out at that point or at the timing of a certain deal. However, they can add value in many other ways. And so, there are times when there are certain partners who put in more money, others who bring more investors who have money, and others who that's just not their forte, but they've got a lot of experience where they can really add value operationally. And so it doesn't have to be that every single partner has skin in the game. But ultimately, if you're going to do a deal, your lenders are going to require that the general partners together have a certain net worth, a certain liquidity, and a certain money, certain amount of money toward the down payment and reserves and all of that, all of that.
Yeah. Okay. That makes sense. And I know one thing you've talked about before is about the importance of a partnership between a visionary and an integrator. Can you explain
Yes.
what that means and what that idea is?
Sure. So a lot of times, certain leaders are very good at a high level, like they've just got vision, like they see, I want to grow this company to be, $1 billion company, and I want this many deals under management, and this is how we're going to build the right team to get us there. And they're very, very high level and have a lot of great ideas. You've got other people who are better at implementation. So they're like, I can take a vision and I can go, okay, this is how we're going to now set up the company, hire the right people, and actually take the vision and put teeth to it and implement it and make sure that it happens. And so one is more of a visionary and the other one's the integrator. And so it's rare that you find leaders who do both really, really well, because visionaries are always thinking about the next thing and the best way, but they just sometimes can't stand to get into the weeds and in the details or stay on task. And other people are like, not as creative. They just don't have that like vision for the future, but they're really good at execution and implementation. So it's really great when you can find the two, that love to stay in their lane and they're passionate about it and good at it. When they come together, then that's when you see, strong successes. And an integrator who's well aligned with a visionary and both on the same page as to where they want to take things.
Yeah, that makes sense. I can definitely relate to that too. I think that's kind of describes myself and my wife. Like we're business partners too. And like, I'm the ideas person. Like I have all these ideas one after another, but then following through on them is a weak point for me. I want to move on to the next big idea. And then,
Yeah.
but like nothing ever, you don't ever get anything done if you don't have somebody that's overseeing, making sure that all these things actually get done in the real world, not just in
Right.
your head. So,
Right.
yeah.
Yeah. And most big companies and great companies have people that are in either of those two functions.
Yeah. Yeah. I can see it. Both are important. Yeah, like there's the creative aspect of big picture, and then there's the getting things done. That's both both equally important, but
For
different
sure.
roles. Yeah.
Yeah. And in the beginning, you kind of have to be both, when you start out doing things on a smaller scale. But once you, reach out to where you're growing and you bring in partners, then it's really good to, as early on as you can, try to find that person that complements you.
Yeah. Yeah. That makes sense. So, okay. Well, good. That's, yeah, it's interesting stuff how these personalities fit together, and it's important to pay attention to that though. Cause if you're both an ideas person, then nothing's really going to get done. So
Right.
once the
Exactly.
motivation wears off, the initial excitement of it. Yeah.
Yeah, for sure.
And you touched on this a little bit before, but about the alignment of goals and expectations. Do you have anything else to add to that? How that could be, because that could create major issues. I can see if you don't address that early on, right?
Yeah, it could. And I think, it's really important early on to make sure that you're both aligned in terms of your own expectations. So a lot of times, again, people will be like, hey, let's start something together. And you really like each other and you both like multifamily and you both like doing deals and you both like the idea of having money. But usually what happens is somebody ends up feeling like they're putting way more time or way more money or way more effort into the business than somebody else. And, if I'll give you an example. If I've got a young single guy who doesn't have any kids, what is his priority going to be? It's make as much money as he can. And he's going to spend, all of his waking hours working to try to make that business happen, at least if he's a go-getter. Okay.
Mhm.
Or someone like myself who has 4 kids and my kids are all in sports every single night and tournaments every weekend. And I have a spouse. I'm not going to be able to give 80 hours a week to a business. I'm going to work hard and strategically before my kids come home from school, but I'm just not going to have that, this business is my life, because I'm trying to build a business that fits within my life, not make business my life. And it's just an example where they might be extremes, but where if we try to build a company together, this guy who's working 80 hours a week is going to be frustrated when I'm not taking calls from 7 to 9 because I'm at my kid's volleyball game. And
Right.
so we need to have those conversations up front to say, what are my realistic expectations for what I can give to the business? How many hours? And maybe if one person's going to put in more hours, the other one's going to put in more money. So you work through those things and you say, how are you going to feel if you are working X hours a week and I'm not? Or, you want to grow in a year, so you want to put $100,000 a piece into the business, but yet I can only afford to put in $25,000 right now. Who's going to cover these costs if we lose a deal or back out after we've put in, $100,000 in escrow? So all of those kind of things are really important. And it's usually time and money commitment. And so we need to ask those real questions of, what are you really able to do? How quickly do you want to grow a business? And am I on the same page as to my expectations of how quickly we grow? When we hire somebody, should we hire someone and build it so that they come, even though it's going to cost us a lot of money or we have to go into debt to do it? And if you don't have those conversations up front, then as soon as you hit the next roadblock, there's going to be conflict and pain points that you could have mitigated if you had just discussed them up front and said, here's our vision together for the company. Here's how quickly we're going to get there. Here's what we have to offer and the bandwidth that we have financially and with our time. And how do we then methodically say, okay, here's our 5-year plan, and let's back into who's going to do what, at what speed and at what pace, and how much money injected, and be able to kind of plan it out where everybody's in alignment to begin with. And I think that that would make for a lot less, business divorces if we did all of those things up front.
Yeah. So being really thorough with those communications, run through these different scenarios and discuss out where everybody's at with that. Yeah. Makes sense.
For sure. And if you're on a different page, that doesn't mean that you can't do deals together, but maybe you say, let's do a deal together. If the deal fits and the timing fits well within what we've got going, let's do it. But that doesn't mean we have to grow a company together. And I'll give you an example. So I have 2 partners who we've done 200 apartment units together in 3 different deals as a joint venture. We didn't syndicate them. And one of my partners and I thought, hey, we've done 3 deals, let's start a company. Well, when we started talking about let's start a company, his ideas and his time frame and the amount, how quickly he wanted to grow and inject money was very different than mine, because our families were at a completely different place in life where we just couldn't come together and have agreement on this is exactly how we want to do this. And so we said, that's okay. We have a great thing going when we've done a deal. We're creating a business marriage on a deal by deal basis. And when there's deals that don't work for us, we just won't do them together. You go do that deal with someone else. I'll do this deal with someone else. And when we find the one that we're well aligned with, where we want to go at that time, we'll still do it together and be great partners. We're just not going to create a big company together because those discussions made it evident that that wasn't the right way for us to move forward.
Yeah. Yeah. That's good. Good to figure that out up front. Do you have any examples? Maybe have you seen, I'm sure you probably have seen cases where people do get into partnerships that don't go so well.
Oh yeah. I've seen a lot of those examples, and usually it is those kind of things, those feelings of frustrations because expectations were not clear up front. And there was disagreements that people just couldn't get past. And, once you're far in and you start having those issues, then it's a lot harder to unwind, when you have a company together and multiple employees and deals and you're like, oh, we don't really like each other, or we don't see eye to eye. And how do we continue to go forward without unwinding? So it's one of the things that makes the apartment syndication world nice when you're doing it with multiple different partners. And in the space, there are a lot of people who partner with different people on different deals. And those tend to seem like they tend to go better because people have a clear role and it's kind of a short-lived role. Most syndications last 3 to 5 years before they go full cycle. So it's like, okay, we've got a short timeline. Here's our role for this deal. We're going to stick to our role. And there's not as much room for things to blow up as there is when you're building an entire company and have to agree on a lot of different things.
Yeah. I guess too, there's an end in sight to, you can make it work at least until that deal is done. Yeah.
Right. Exactly.
Okay. And then what about when it comes to fulfilling investor expectations? I'm sure that's something you'd want to talk about too, right? Like what kind of sacrifices you're willing to make if something goes wrong or whatever.
Sure. Usually up front when you're developing your PPM, your PPM is going to scare away all your investors. It's designed to scare people away and to say, these are all the things that could go wrong. But in that PPM, you're very clearly discussing like what things could go wrong and what would happen. And most of the time it says, your operator is going to make best efforts to perform all of these things, given everything within their control. But that ultimately you could still lose money. So, it will say whether, okay, well, what happens if you run out of money and you need to do things? What's the expectation? Do we expect the general partners to come up with the money? Are we going to do a capital call where all limited partners who have invested have to invest a certain amount, more to keep things afloat before we, chance having to go into forbearance or foreclosure? And if someone can't fund and they're asked to fund additional funds, what happens to their investment? Is it minimized and more shares are sold to the people that are putting in additional investments? Do we immediately have the right to buy them out? So the PPM is going to spell out for your investors exactly what to expect if and when things don't go as planned.
Okay. All right. And so are there any red flags that our listeners should be aware of when they're considering going into a partnership, things that would be a clear sign that this isn't a good idea? Now let's take a moment to thank our sponsor. When we return, Anna shows the red flags to look out for before going into a partnership, when it's better not to do a deal, and the surprising circumstances when you find the perfect partnership but still choose not to work together. So stay tuned. Do you have a good system for communicating with potential investors from the time they contact you the first time to the point of them making their first investment and beyond? Well, ActiveCampaign is a great tool for email marketing and automation. You can create a series of follow-up emails that each new investor will receive that nudges them toward taking the next step, whether that means booking a call, creating an account in your investor portal, or giving a soft commitment. And it does more than just email marketing. It has CRM functionality too, where you can keep notes on your investors so you have their history with you at your fingertips. We use ActiveCampaign in our business, and I've seen a lot of successful syndicators use it in theirs. You can get more information by going to apartmentinvestorpro.com/AC. That's AC for ActiveCampaign. Just to be transparent, that is an affiliate link, so if you decide to order, we may make a small commission at no extra cost to you. But we're only recommending it because we used it ourselves and we know that it works well. Again, that link is apartmentinvestorpro.com/AC. So are there any red flags that our listeners should be aware of when they're considering going into a partnership, things that would be a clear sign that this isn't a good idea?
I think if you're not well aligned up front in any way, that's a big deal. I think it's a yellow light and, requires more digging. So if you just don't feel that in your gut, some important things are well aligned, it's better not to do a deal than to try to force it because, hey, we both, want to stay friends and this is a good opportunity. Like if there's anything that just makes you go, this could end up being a problem. Sometimes it's personality and sometimes it's conflict resolution, it's reputation. I mean, if there's someone that has a reputation of having multiple relationships and deals fall apart, if they're, harsh or arrogant or, very, very controlling and they don't respect you and your thoughts up front, that's probably a good sign that maybe you shouldn't move forward. If there's any questions about integrity, deals that they've done in the past where, maybe they did something unscrupulous, I'd say stay away. It's better to not do a deal than to do a deal with someone that you have any question of their integrity or their competence, their propensity for collaboration. If you're going to partner with someone, they have to be collaborative. They have to be able to give and take, to clearly communicate and to have respect for, the value that all partners bring. If someone thinks that the value that they bring is so much more than the value that anybody else brings, that could be a red flag because you want somebody that is a team player that says, we want the best for all of our investors, for all of our partners. Let's make sure that we're, all willing to sacrifice and to have our partners back. That's really important. So sometimes you can get a feel for that, up front. And I think it's better to date, than to jump into marriage. And so, maybe you do something small, really small together first before you, do something really big together.
Yeah. All right. Okay. Good. And so obviously there are some risks involved. Is this partnership strategy something that's for everyone, or how can someone decide if it is a good idea for them to have a partner?
Partnerships sometimes are built out of necessity. I think a lot of people have the personality that they'd rather be in full control of what they do and only own their own investments and not have to share the equity and share, the work and have to get, permission for decisions from somebody else. But ultimately, we need partners because we all either run out of time or money, or we just don't have the skills set and the passions to do certain things that are needed. And so if you are kind of the kind of person that just likes to have control of everything and you have a hard time giving up control and trust, you might be better served if you've got the money to just do your own deals and build your own portfolio. If you're somebody who lacks either skills, time, or money to continue to grow on your own in your own portfolio, then you should consider a partnership. And you've got to think about, what am I willing to give up control of? What can I trust someone else to do? And what do I not love doing that if I had someone that loved to do it, we'd grow a lot faster than I would do it on my own? And I think when you ask yourself those questions, it becomes easier to say, okay, yes, I'm going to have a partner. If you're someone that you have the skills and the competence and the desire, to do all of it, but you just don't have the money, then maybe you create some joint venture partnerships where you have, limited partners who are funding the deal, and then you run the show, by yourself. Just know eventually you're going to run out of bandwidth because you can only do so much.
So it seems like an important first step is really to know yourself then and know what you can offer in the relationship. Would you say that's the case?
Oh, 100%. And basically go through a series of questions that, you should ask yourself and you should ask your partner, and you should be able to answer for your partner. So it's not just, I'm interviewing you to see if I want to be your partner, but here's what I have to offer. Here's what my personality looks like. Here's what my communication style looks like. Here's what my vision for growth looks like. Here's what my bandwidth and my passions and my skills look like. And so that both of you have complete, two-way communication for figuring out, is this a good fit as a partner? And then is the deal that we see a good fit for both of us? And if the deal isn't a good fit, then maybe you say, hey, when we find the deal that aligns with all of this, then that's when we're going to do, a deal together.
Yeah. Okay. Can you give us some examples of some specific questions you might ask a prospective partner to see if it looks like a good fit?
Sure. So, the first thing is, what's your financial goals? So I look at every opportunity out there, multifamily investment, any other, real estate investment, as well as, where is the opportunity? What is the level of time that's needed to create that value? How long of a hold does this deal, is it conducive for? So for example, is it a buy and hold deal or is it a value add deal? Is it a heavy value add and a major reposition where we have to go into bridge debt and move really quickly, where there's a little more risk, but there's big reward on the back end? Or is it something that's like super vanilla? There's a little value add because we can bump rents $200 by putting in flooring and paint, poorly managed before. Like, what is the risk level and what is the return level? And then is that aligned with where I am? So as an investor, we need to look at ourselves at all time and say, are we in a phase of accumulation where we need income? Like, that's our primary goal, is I want to retire from my job. I need X number of dollars per month. I need deals that generate income. Or have I moved beyond my income needs, and what I really want is big checks at the back end? I want to grow my net worth, but I'm not as concerned about whether I make cash flow month to month. Or have I had the income and had the growth I need, and now I just want safe deals that preserve my capital? So I need to know, where am I on my wealth building, continuum, and where are my partners and where are my investors? Well, if I need the cash flow and you don't care about cash flow, you just want the check at the back end, you're going to be more open to risk for big payouts at the back. And I'm going to be like, I don't want to take that risk, and I can't have a no cash flow deal for 2 years because I need the cash flow today to survive. That's a big one. Yeah. Because if you get that well aligned, then you're going to like the same type of deals. And then it's going to be easier to say yes to a deal or to say no to a deal. So that's a huge one. And then the next one is really the time commitment. How much time can you really give? If you had to spend your time wisely and you could only give me 4 hours a day, what would you be best at? What are you most competent and comfortable at and passionate enough about that I can rely on you to execute what you need to do? So that's big. And then the last thing is more just kind of the personality kind of questions. Are you easily offended, or are you able to take constructive criticism well? And that may be a hard question to ask, but we have to be able to answer that. I know some people that you say, you did a great job, but next time maybe you should think about how you say something more tactfully. And if they blow up at me for making that kind of comment, it's probably not going to be a good partnership.
Yeah.
Or if you say, so that kind of thing, how do you communicate? Do you like in-person communication? How often do you want to be communicated with? Can you trust me with certain decisions, or do you feel like we need to collaborate on every single decision in every single area? So just those kind of, communication and conflict styles, pride versus humility, brash versus tactful, relational versus like all about the numbers, choleric leader kind of people tend to be less people, and other people tend to like love people and don't want to hurt people's feelings, but they're not great, leaders and executors. And so I think you have to ask all of those questions: time, competence, character, personality, and financial goals.
Yeah. Really important things for sure. And so do you have any advice about maybe reading between the lines? Maybe like somebody, you think you understand where they're coming from, or maybe they think they know where they're coming from, or maybe they're trying to make you think they're coming from a certain place, but maybe they're not. Any advice about like kind of reading between the lines with?
I think that over time, our discernment radar grows and we're able to do that, better. I think if we go in, and I'm very much I'm very much an optimist and realist. So I want to give people the benefit of the doubt. But when you're going to think about partnering with someone, I think you've got to basically put on that, like, I'm going to be a little bit pessimistic, and let me just see let me make sure that I'm asking all the questions. I want to give the benefit of the doubt, but I want to assume that I'm trying to uncover any red flags that I need to uncover. And so if you go into everything they say with a healthy dose of skepticism to say, okay, let me dig a little deeper on that. Like, give me some examples. And so maybe you ask, give me some examples when you had a business relationship that really didn't go well, where there was just a lot of conflict. Like, give me an example of how you navigated that, something that happened and how you navigated that, and ask how they navigated that. And sometimes that will draw out personality. Oh, this guy just did this. And, I did nothing wrong, but it was a problem. Or did they say, I had a situation where we had conflict and I tried to resolve it. We had a lot of discussions about, how can we resolve the conflict, but this person wouldn't, or I learned from that because I was being too harsh. Like, do they tell you the truth about conflict in the past, or lessons learned, or do they gloss over it and they've never done anything wrong and have nothing to learn? So those are the kind of questions that I kind of like to ask, just to see, what someone's personality is like, to help you to dig deeper into, gosh, this person just seems too good to be true. Are they, or is there something that they're hiding or covering up? Asking for references from people they've worked with and done deals with before. If you're not both new, and they've been in the space, it's kind of a small network. And so people tend to know, things about people. So being able to ask those questions, hey, can you give me references from people you've done deals with in the past that I can give them a call and ask about your experience? And they should be happy to do that.
Yeah, you can see it's kind of like a job interview in a way. You
Right.
try to ask those kind of wide range of questions, and I mean that's something that comes up, like what, a situation where maybe asking about weaknesses or something like that, and if they think they don't have any, then that could be a problem.
Yeah. And I like to see sponsors underwriting too. So, you talk about the personality things and the vision, and that's important too. But like, I like to see, okay, you have a deal that you've done or that you're interested in. Show me your underwriting and let me see, how you project changing this deal. And there's times when I see someone's underwriting that I realize they're much more aggressive than I am. I'm much more conservative. And I feel like, even though their underwriting showing some certain great returns, that it's unrealistic, or I couldn't sell it to my investors because it didn't have, for example, no rent growth year one, or, a cap rate in the future that's higher than what it is today. So there's things like that I can tell their risk tolerance and how detailed they are based on underwriting. And that might tell me that, we should talk about that. So let me see your deal and then talk to me about this. Tell me why you don't think that you should, model no rent increases at 3% every year, or, why you can meet these rents, or how you're going to deal with the crime in the area, even though you're saying it's a Class A area. So those kind of things, if you see it, gives you an ability to talk through, hey, are we well aligned with the types of deals we want to do together and how we view, those deals and risk tolerance. And it might be that that's enough to make you say, I think we could be well aligned for a more aggressive deal, but right now myself and my investors are more conservative. So as much as I like you, I don't think we could form a company together, or we couldn't do this particular deal together. So that's kind of a better way to say no than like, I just don't like you, or something like that. So yeah.
Yeah. Okay. And you mentioned too about like if they you're talking about experiences where things didn't go well, partnerships and things. I guess what you're looking for really is their own accountability in that, like, because that if they don't have that accountability, everything is always somebody else's fault, then that's going to really create problems in your own business, isn't it?
Exactly. Yeah, because I think we need open communication, and conflict resolution is super important in a deal, because when you're dealing with big deals, you're dealing with big dollars and big risks. And especially when you have investors' money involved, you don't want something to go wrong in a partnership that's going to influence the operation of your building or your investors. And so you've got to make sure that, I have investors ask me, have you done a deal with this other person you're partnering with? Well, how do you know that you're going to be a good fit? So a lot of investors would rather invest with people who've done 2 or 3 deals together that have gone full cycle, because they know that they have less risk that partnership's going to blow up, or the partners aren't going to like each other anymore. And so, there's wisdom in that. And so the more we can do to assume that things could go wrong, talk about upfront how we would resolve those things, and talk about what things we could see maybe being issues because we have slightly different personalities, and talk through that, the better our investors will be and the better we'll be for it.
Yeah. Okay, good. Yeah, makes a lot of sense. And so then once you do find a compatible partner, somebody you think you can work with, what's the next step? And do you need to get something in writing, or how does that work?
Yeah, I think it depends on, are you going to start a company together, or are you going to do a deal together? And so if it's just, hey, these are the kind of, let's do a deal together. And I suggest that for the most part, most people decide to do a deal together before they form a company together, like a company that's going to grow with staff and buy a bunch of apartment buildings. If you do a deal together, you're basically agreeing to date for the next 3 to 5 years. Okay. And at that point, you need to have a document that at least kind of says, these are the types of deals that we want to go for. Here's where here's the time commitment we're able to give to this deal. Here's who's going to raise the money. Here's who's going to talk to brokers. These are the kind of deals we're going to target. And then once you find that deal, when you create your operating agreement for the LLC, and this is something, you can kind of have pre-planned, but once you have a deal under contract, if it's over $1 million loan and you're probably going to go agency debt or CMBS or whatnot, you're going to have to create a special purpose legal entity. So that legal entity is going to own that asset. And at that point, you're going to have an operating agreement for that legal entity. So in your operating agreement, I suggest you have a roles of partners addendum. And that roles of partners is going to make very clear, Todd is going to do XYZ for this company, for this apartment complex. Anna is going to do ABC for this apartment complex, for this entity. And so that way it's very clear the separation of duties and who does what. And anything that's a shared responsibility would also be in that roles of partners document. So you can really form that on a deal by deal basis. And maybe for one deal, it looks one way, and for another deal, it looks another way. So even when you form a company, typically that company is going to be like a parent company or manager of a separate legal entity that only owns that one property. If you're creating a company, then you've got a much larger operating agreement, much more in-depth roles of partners document as to how that company is going to grow, a business plan on growing that company, and very fine level of details of who wears this hat till when, how often do we meet, who makes executive decisions, where are the voting rights, what are the ownership percentages. So, all of that has to be memorialized, and it can take a long time to hash all that out.
Yeah. Okay. So, but on the shorter term deals, then those roles are kind of outlined in the operating agreement. That could be different deal to deal than if you're just working short term then.
Absolutely. Yeah.
Okay, great. Well, you've shared a lot of really powerful information today. Do you have any final thoughts about partnerships that you'd like to share, or maybe how you'd sum it up?
Sure. I'd say, partnerships can be a really good thing. In order to scale and in order to grow, it's very, very difficult to do it alone. But just be very, very patient and cautious into forming partnerships and make sure you're going in really with eyes wide open, having asked all of the key questions, regarding your financial goals, your time, your money, your skills, and your passions. When you align all those things well, it becomes kind of like that perfect pair of shoes. We know we're going to be a good fit. We're going to walk together. We may hit some bumps, but we're going to be, together in step, rather than I'm wearing a high heel and you're wearing a tennis shoe and we're going to constantly step on each other and not be going the same direction. So look for that alignment of somebody that really feels like, wow, this is such a great partner that complements everything I'm doing. We want to go in the same direction. Our risk tolerance is well aligned. We're both collaborative and respectful of each other. And then say, okay, great, let's find that deal that we can do together as kind of the dating or courtship period. And then after we've done one together, we'll see where it goes.
Awesome. Okay. Well, that's great. Great advice. So can you tell us what's the best way for our listeners to connect with you then?
Sure. So I have two websites. One is more coaching and speaking related, which is reimom.com for real estate investor mom. And my capital company is called Greater Purpose Capital, and it's greaterpurposecapital.com.
Okay, great. Well, we'll be sure to include that in the show notes. So thanks so much for coming on today. Really shared some very powerful insights on creating partnerships. So thanks so much for that. We appreciate it.
Welcome.
All right. Have a great day.
You too.
If you're ready to partner up, that's great. You'll be able to scale faster with other star players. But how can you know you're choosing complementary partners? Start by assessing, then addressing your weak points and strengths. Knowledge is power. I've put together a free guide called Build Your Multifamily Investment Team Resource Guide to help you. Download it at apartmentinvestorpro.com/build team. That's BUILDTEAM. Again, apartmentinvestorpro.com/build team. And download it now so you can make solid decisions that will give you the advantage you need to succeed. Thanks for listening to this episode of the Apartment Investor Pro podcast. Be sure to subscribe to get the latest episodes. Also, visit our website at apartmentinvestorpro.com and connect with us.